All right, guys. I've got a bunch of people who are just starting investing, and while I always recommend picking like an index fund that mirrors the S&P 500 or an ETF that mirrors the S&P 500, you use these other asset classes, like you start using the names, and people are like, "Oh, what's this or what's that?" So I kind of want to go over the different asset classes and kind of talk about them because the investing landscape can be extremely dynamic and it's always changing and evolving, right? But those who take the time to understand the basic principles in different asset classes, they stand to gain, significantly over the long haul. So the first step is going to be learning to distinguish the different types of investments, and then we're going to talk about like where each type is on, on a risk standpoint, like what's more risk, what's less risk, right? Let's start off with trying to understand the investment risk ladder, and we're going to go over some of these major asset classes, and we're going to start in ascending order of risk, right? So the first one, it's going to be cash, because a cash bank deposit is the simplest, most easily understandable investment asset and the safest. It not only gives, investors precise knowledge of the interest that they'll earn, but also guarantees that they'll get their capital back. Now, on the downside, the interest earned from cash socked away in a savings account, it seldom beats inflation. Now, CDs, or certificates of deposit, are less liquid instruments, but they typically provide higher interest rates than those in savings accounts. However, the money put into a CD is locked up for a period of time, say a couple months or a couple years, and there are potentially early withdrawal penalties involved. Now, the next one to talk about is going to be bonds. A bond is just a debt instrument representing a loan made by an investor to a borrower. A typical bond will involve either a corporation or a government agency where the borrower will issue a fixed interest rate to the lender in exchange for using their capital. Bonds are commonplace in organizations that use them to finance like operations or purchases or even other projects. Bond rates are essentially determined by interest rates. Due to this, they are heavily traded during periods of quantitative easing, right? Or when the Federal Reserve or other central banks raise interest rates, right? The next one I'll talk about is going to be mutual funds. Mutual fund is a type of investment where more than one investor pools their money together to purchase securities. Mutual funds, they're not necessarily passive as they're managed by portfolio managers, which, they're who allocate and distribute the pooled investment into stocks and bonds and all the different securities. Now, individuals may invest in mutual funds for as little as about $1,000 a share, letting them diversify into as many as 100 different stocks contained within, a given portfolio. Mutual funds are sometimes designed to mimic underlying indexes, like the S&P 500 or the Dow Jones Industrial Average. Now, there are also many mutual funds that are actively managed, meaning that they're updated by portfolio managers who carefully track and adjust their allocations within the fund. However, these funds generally have greater costs, such as yearly management fees and front end charges that can really cut into your returns. Mutual funds, they're valued at the end of the trading day, and all buy and sell transactions are likewise executed after the market closes. The next one to talk about is going to be ETFs. Exchange traded funds, they've become really popular since, they were first introduced back in the mid 1990s. ETFs are similar to mutual funds, but they trade throughout the day on a stock exchange. In this way, they mirror the buy and sell behavior of stocks. This also means that their value can change drastically during the course of a trading day. ETFs can track an underlying index, just like the S&P 500, or any other basket of stocks with, which the ETF issuer wants to underline a specific ETF. Now, this can include anything from emerging markets to commodities. Individual businesses, sectors such as biotech or agriculture, whatever it might be. Due to the ease of trading and broad coverage, ETFs are extremely popular with investors. Then, of course, we're going to get to stocks. Now, shares of stock let investors participate in a company's success via increases in the stock's price and through dividends. Shareholders have a claim on the company's assets in the event of liquidation, right? That is, if the company goes bankrupt, but do not own the assets. Holders of common stock enjoy voting rights at shareholders' meetings. Holders of preferred stock don't have voting rights but do receive preference over common shareholders in terms of the dividend payments. Now, those are the main ones, so let's talk about some of the alternative ones, right? Because there's a vast universe of alternative investments, right? And one of the first ones to talk about, of course, is a lot of people's favorite real estate. Investors can acquire real estate by directly buying commercial or residential properties. Alternatively, they can purchase shares in real estate investment trusts or REITs. Now, these REITs act like mutual funds wherein a group of investors pool their money together to purchase properties. They trade like stocks on the same exchange. So, the next thing to talk about is going to be hedge funds. Now, hedge funds may invest in a spectrum of assets designed to deliver beyond market returns. This is going to be called alpha. However, the performance isn't guaranteed, and hedge funds can see incredibly, large shifts in returns. Sometimes underperforming the market by a huge margin, sometimes overperforming. Typically only available to accredited investors, though. Now, these vehicles often require high initial investments of $1 million or more. They also tend to impose net worth requirements. Hedge fund investments may tie up an investor's money for a long time. Private equity fund is another thing to talk about because private equity funds are pooled investments, similar to mutual and hedge funds. Now, a private equity firm known as the advisor pools money invested in the fund by multiple investors and then makes investments on behalf of the fund. Private equity funds often take a controlling interest in an operating company and engage in active management of the company in an effort to bolster its value. Other private equity fund strategies include targeting fast-growing companies or startups. Like a hedge fund, private equity firms tend to focus on long-term investment opportunities of about 10 years or more. One of the last things is going to be them commodities. We can't forget those. And commodities, they're going to refer to tangible resources. Think like gold, silver, oil, right? As well as agricultural projects, right? There are multiple ways of accessing commodity investments. A commodity pool or managed futures fund is a private investment vehicle combining contributions from multiple investors to trade in the futures and commodities markets. A benefit of commodity pools is that an individual investor's risk is limited to her or his financial contribution to the fund. Now, some specialized ETFs are also designed to focus on commodities, so I just want to make sure you guys know that. So then we got to think about how to invest sensibly or suitably or even simply, because a lot of veteran investors, they diversify their portfolios using the asset classes that we just talked about, with the mix reflecting their tolerance for risk. A good piece of advice to investors is to start with simple investments and then incrementally expand their portfolios. Specifically, mutual funds or ETFs are a good first step before moving on to individual stocks or real estate or any of the other alternative investments that you feel like you can get into. However, most people are too busy to worry about monitoring their portfolios daily. Therefore, sticking with index funds that mirror the market is a very viable solution. Someone named Steven Goldberg, a principal at the firm Tweedle Goldberg Wealth Management and longtime mutual fund columnist at Kiplinger, he argues that most individuals only need 3 index funds, one covering the U.S., one for the equity market, and another focused on international equities, right? And it's just like you're good. Now, what does this bring us to? Like, what is the bottom line, the key takeaway? Like how do we wrap this up and sum it up? Okay, investment education is essential. Now, as is avoiding investments that you don't fully understand. Rely on sound recommendations from experienced investors while dismissing the hot tips or, stuff like that from untrustworthy sources. When consulting professionals, look to independent financial advisors who get paid only for their time instead of those who collect commissions. And above all, diversify your holdings across a wide swath of assets. So I really hope you guys got some good information out of this. You got a good starting point for yourself. Maybe not the best starting point to start investing, but at least the best starting point to do a little bit more research. And if you don't want to, or you have a question, you can just ask me. Just feel free. Write it down there in the comments, and I'll get to you. I promise. But if you liked the video, hit that thumbs up button. If you're not subscribed to the channel, I appreciate if you did. But until I see you guys in the next video, y'all be safe.